This is the Argent Wealth Management April to May 2024 market view, and this is Matt Restuccia, the Chief Investment Officer at Argent. You can see Argent's differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. Please connect with us LinkedIn, Instagram, Facebook, X, and YouTube, where we post this narrated version of our market view. So let's start with the conclusion. The stock market might be at the start of a correction within an ongoing bull market. If not, a correction is likely at some point between now and the fall. Investors will likely get more pessimistic before the correction ends and the bull market resumes, and look for repositioning opportunities during a correction. So let's look at large cap stocks and what's happened so far this year and over the last couple of years. So the S&P was up over 45% since October 13th, 2022. That was the low in the last bear market. And it recently peaked on April 1st. However, the S&P is now below its 200-day moving average and is about 4% off its high as we stand right now on April 17th. The S&P 500 also note in the middle clip here that it's at the high end of its valuation range over the last couple of years at 20 times. Not super expensive, but on the higher end of the range. And its dividend yield is on the lower end of its range at 1.39%. Let's contrast that with small cap stocks. So the Russell 2000 index of small cap stocks was only up around 30% since October 13, 2022, well below the 45% of the S&P. And the Russell 2000 is now down 7% since its recent peak on April 1st and has dipped below its 200 and 100-day moving average. But it's now at the lower end of its valuation range and the higher end of its dividend yield over the last 2 years, unlike the S&P, which is the higher end of its valuation range. While the S&P 500 has made new highs in April, the Russell 2000 remained 18 percentage points away from its all-time high. If the bull market continues, it is likely small cap indices will exceed previous highs. And so for that reason, combined with a lower valuation, it means that they potentially have more upside than large cap stocks. So what's going on with small cap stocks anyways versus large cap? Well, they're more sensitive to interest rates. Debt over market cap ratios tend to be higher, and so they can borrow at higher rates. That means they are more sensitive to interest rates and more sensitive to the Fed funds rate. So this higher for longer interest rate regime that the Fed is now in, which we'll get more into later, has continued to hurt small cap stocks relative to large caps near term. I do think when this dynamic shifts that the small caps will benefit more than large cap. The dynamic shift being when the Fed starts to make clear they're going to start lowering interest rates. So let's talk about corrections. And, what's the deal? Well, they're actually quite common within bull markets. Stock markets are volatile. It's been about 105 days since our last 5% correction. That's market days. That's almost 40% of a year. And it's also been 105 days since a 10% correction. Historically, 5 to 10% corrections in that range occur about every 51 days. So we're about we're overdue. A 10 to 20% correction happens every 172 days. So we're not overdue for one of those yet. And if you look at the presidential cycle, what typically happens to stock markets on average, during the presidential 4-year term, the election year tends to be a good year, but it tends to be pretty choppy in the first half. So that would support the case for a correction with an ongoing bull market and to have a correction around this time of year going through the summer. But recession odds remain low. So despite the potential for a correction, a recession is unlikely. As you can see here, the Ned Davis Research Recession Probability Model is in its low zone. Major drawdowns or bear markets usually occur when the odds of recession are high or increasing. So for instance, when we had that bear market in 2022, when the S&P was down about 25%, the odds of a recession were high. And this model is based on leading indicators for 35 countries. So these are leading indicators saying, there's a high chance for a recession. We didn't end up having one in the US. Other countries had more of a slowdown than us. But you can see when we went from low odds to high odds, that's really when the market got hit. Right now, we're trending down. The odds of recession are low and trending down. And the economy remains strong. I mean, there's 1.4 times the number of job openings per unemployed right now. So, you're really hard to get a recession when the employment market is so strong. And consumers are in good shape. The financial obligations ratio is below his historical average, and consumption is about 70% of GDP. When we're seeing consumers, people in the US continue to, consume. Retail sales were strong this month. People are still buying homes. There's opportunities to get jobs or change jobs if you don't like your job. So the consumer's in good shape. In credit conditions, the ability to get a loan to expand your business or buy a home, whatever it may be, are favorable. Despite interest rates being higher, the availability of credit is still there. And typically you would see that the credit conditions index would start to trend downward before a recession. And we're just not seeing that. We're seeing the trend upward here. But the strength of the economy is the very reason inflation has remained stickier than expected and why we may get a correction. Stickier than expected inflation has decreased how much investors expect the Fed to lower interest rates. Higher for longer than expected interest rates has caused investors to become more cautious. Rates to borrow remain elevated for both consumers and businesses longer than expected. That increases their hurdle rate to make major purchases, investments, or capital expenditures. So, investors expected rates to be between 4 and 4.25% by this September. Now, the expectation is that rates are likely to be in the 5.525% range. So you can see why, despite being in a bull market and recession odds being low, the market is coming to grips with the fact that if interest rates stay higher for longer, higher hurdle rates for investment, longer to get earnings growth, although earnings are still growing. But that also probably means that the bull market could be longer than it would be if this was a V-shaped type of recovery. Inflation was coming down quickly, the Fed was lowering rates quickly, the economy was soaring, and earnings were increasing rapidly. The bull market may not last quite as long. So I think this is okay. Getting some volatility is healthy in markets. It creates opportunities. Especially when it's within an ongoing bull market. It can make the bull market last longer if it's not such a quick cycle. You can see here sentiment, the old adage, buy when others are fearful. Well, we were far from fearful at the recent peak for the S&P 500 in April, and even in January. In January when investors expected up to 5 rate cuts, the trading sentiment here was in the extreme optimism zone, almost as high as it gets, around 87. Since then, it's made its way down to 50. So investors are feeling somewhat neutral now about the stock market. So a correction in the 5%, 10% range would likely cause, sentiment and, to drop and fear to increase, so that we would be in the extreme pessimism zone. And there, the S&P has averaged 24.99% a year since 2006. So once we get in that zone, as long as the economic indicators still look pretty steady, I think that would be a good time to maybe increase exposure in portfolios, especially to small cap. Presidential sentiment. Unless the mood about the president's extremely pessimistic, which often coincides with an external economic shock like the 2008 financial crisis, you can see here, which is really the thing impacting markets. People not feeling so great about the president or the presidential options, it's not bad for the stock market, despite what popular belief might be. And with the odds of a recession low and a correction, more likely than a bear market, what happens if the bull market does resume? What does it look like historically? Well, the average for all bull markets, going back, is about 86% gain over 576 market days. So right now we're up about 30% over 400 days. So still a long way to go, both in time and in percentage, but we are in a long-term bull market. In bulls, shorter-term bulls within longer-term bulls. We call it cyclical bull within secular bull, which is what we're in today. I believe returned about 105% over 751 days. So that would be, we're about halfway through, and from a time perspective, but maybe only 30% of the way through from a return perspective. So I do think there's more returns to come, and that investors should use this volatility to their advantage and potentially increase risk and recalibrate portfolios smartly, which is what we'll do at Argent. So at Argent, we customize portfolios. We have an open architecture way of investing for clients, custom, but we do have some investment strategies. We have value, hedge fund, asset allocation strategy using ETFs and mutual funds, a high dividend, an innovation growth strategy. We do private equity, private real estate, and we do fixed income as well, along with our partner at Hightower. So we really cover the bases here. If you're looking for a strategy or you're looking for custom portfolios, we really do what's best for our clients here. Again, Matt Rastusha, CFA, charter holder, chief investment officer, and principal at Argent. Thank you for listening.